name is Taylor Britt. I am the Vice President of Marketing for the Difference Card, and I will be your host today. Monthly Budget launched about a year ago. So we're going to spend a couple of minutes at the beginning of this session reviewing Monthly Budget and how the solution has impacted our Difference Card clients. And then, of course, we want to talk about the success that Monthly Budget has had for a lot of industries. We're going to show you guys what it was like for a California technology company. We're also going to explore how this solution worked for an Ohio manufacturing organization. And then we'll kick it over to Ashley, and she's going to talk about a really neat case study for a New York nonprofit organization. So a lot of really great real world examples here so you guys can see how this solution is working all across the country. Finally, we'll wrap it up with the target market for Monthly Budget and give you guys a little bit more information on how to quote if it seems like it's a good fit for your clients. All right, without further ado, I'm going to pass it over to Josh to introduce himself.
Thank you, Taylor, and good afternoon, everybody. Josh Pyzik. I'm the sales director for our Midwest and West markets, and appreciate y'all joining today. Ashley.
Great, thanks, Josh. Good afternoon, everyone. My name is Ashley Doobie. I'm the Senior Director of East Market, so in charge of new business sales, really from New England down to Florida, and I've been with the organization now for 10 years. Chris?
Hey everyone, Chris Calderon. I'm the Chief Revenue Officer for the Difference Card, run our national sales and marketing practice, and really excited about the Monthly Budget solution. We had a great launch last year. So I'm going to start things off here by kind of kicking it off with the year in review. And before we talk about the solution and how Monthly Budget can fix this problem, let's just kind of address the issue that a lot of your customers are facing, which is this rising cost of healthcare. And as we updated this for the latest year of 2024, that's kind of available through the Kaiser Family Foundation studies, we just noticed how high the rate of inflation has been on healthcare compared to regular inflation. And that's all we hear about in the news is how high inflation is. But can you imagine that healthcare inflation is almost double the rate of regular inflation and wage growth? So 50% increase in health insurance costs over the past 10 years is just completely unaffordable. If you just look at that $25,000 price tag for family coverage, just totally unaffordable. And I know you all are feeling it in the client renewals that you're dealing with, double-digit increases across the board. And it's really across the country. We're seeing it in every state and every market, big rate increases. So that's a problem for many employer customers that the Monthly Budget solution has been a fix for. And we're going to talk more about how that works in 3 states today as we go through the case studies. Just a refresher for those of you that may be new to the Difference Card solution, we've been around for 20 years. We've got 1,500 plus customers on the block of business, so pretty substantial size now. And the basic concept is to pay as little as possible in fixed premium to the insurance carrier, but still keep your client with the same carrier typically and keep the benefit structure intact. But instead of paying $1 million for a rich gold type plan, let's buy a higher deductible option that costs, let's say, $700,000 to get a nice decrement. We're going to fill in the gaps using the Difference Card MERP solution, the medical expense reimbursement plan, and the net savings to our customer, to the employer, would be about $180,000 or 18% net off of their healthcare cost, typically giving the employee the same great benefits, using the same network, same carriers, but saving them a lot of money by funding the plan differently. So that's what we're going to show you is how that MERP strategy works. And the Monthly Budget feature has really been the easy button. It's a much simpler version of the MERP solution that's really taken off with a lot of our customers. So as we think about the success we've had of this solution, it really started in early Q1 of 2024. We did kind of a soft rollout of this. And then last Q2, around this time last year, we did a big launch and a big webinar like this. We had a lot of you join that. And the product has really grown as you've all taken it to your customers and to your prospects. We've seen over 230 new groups come in through this solution just in the past 12 months alone. And a lot of that has been new business for all of you. So it's not just existing customers solving that renewal problem. That's certainly one way to use this, but it's also a way to win new business because it's a new solution. It's that easy button on the administrative side that your customer maybe has not seen before, or that prospect, nobody else has shown it to them yet. So excited that a lot of you were able to win new business using this strategy. And there's a lot more white space out there. We know there's a lot of potential to do more of this as we continue throughout this year and into 2026. So just a reminder that the monthly budget feature is really powered by the difference guarantee. We've had this program in place for the past 7 years. We're partnered with Assurant. They're our exclusive insurance carrier, A-rated, $5 billion reinsurance division that allows us to guarantee savings for our customers. And historically, we've done that on an annual basis where we've said, okay, you've got a guaranteed annual claims amount, and if you go over that, we'll pay you back. Well, the monthly budget feature of the difference guarantee allowed us to turn it into a fixed monthly payment model, very similar to level funded, where your customer, they just pay the fixed service premium every month, and then they also pay the fixed claims maximum on a month-to-month basis. And the only thing that would change is the enrollment. So we give them a PEPM amount times the enrollment. They pay that on a month-to-month basis. And then at the end of the year, we do a final accounting for your customer and say, okay, if you went over the max, if you had more claims than what we expected, well, that's great. You picked the right plan and you never had to pay any more than that maximum amount, and Assurant backs up the excess claim amount. If you ran better, and about 60% of our customers run better than the maximum, well, then you actually get surplus back. And a little different than level funded, you get 100% surplus return. So we return all of that excess money. If your client ran better than the maximum, they're going to get 100% return on that surplus, and they get it about 60 days from the end of the plan year after we've done all of that final accounting. I get the question a lot of, well, where does this monthly budget and MERP solution kind of fit into the alternative funding spectrum? And alternative funding is a really hot topic lately. Everybody's looking for new ways to save money and contain costs. So many groups are still in fully insured. I think 50% of the market is still fully insured. So there's a lot of white space there to attack that fully insured space. We're also seeing growth in the level funded market because the MERP can sit on top of either a fully insured arrangement or a level funded plan. Works really well with either of those underlying plans. It's that next step up, paying less in fixed cost, but keeping the benefits intact, saving money for that employer. And many groups will use this as a stepping stone to self-funding. You're collecting data, learning to pay your own claims, and then it may make sense eventually for the right risk, right group to take that final step up the spectrum. So why don't we pause there for a minute and ask a question about how comfortable you all are with alternative funding?
Yeah, Chris, great question. So which alternative funding solutions have your clients utilized to contain health insurance costs? Is it level funding, MERP daily funding? This is where you're paying the claims as they're incurred, a pay as you go. Or the MERP monthly budget funding solution, which we're talking about today, or perhaps it's self-funding. Seeing a lot of answers coming here. We'll give everyone just a couple more seconds to participate. All right, let's share these results. So it looks like the top winner here is level funding, with nearly half of the audience, 44%, saying they've used this solution. Coming in second place, self-funding, and then we've got monthly budget, and then MERP daily funding. So I think we've got a lot of opportunities here, Chris, to teach the team about some things.
Yeah, and interesting that we're seeing more monthly budget funding than daily funding. So definitely that's been the trend lately, is moving towards that monthly budget solution. Why don't we pass it over to Josh next and have him take us through the first case study here?
Yeah, thanks, Chris. Interesting results. And I think it's good to point out that, like you said earlier, Difference Card can set along level funded clients too. So those partners out there that are looking at level funding, the MERP solution could be an addition to that as well. But let's walk through a couple of clients here, one from California, and then I have another one from the Ohio market. So first one here, not unique to a Kaiser group, with a pretty hefty renewal increase in 2024. So we're looking at about a 60 life group, looking at about over a 40% renewal increase. Implementing the difference card, manipulating that Kaiser plan, then implementing the difference card got that group down to, yeah, still an increase, but cut the increase in half down to 21%. And that was on our maximum basis on the level fund or the monthly budget funding basis. They saved guaranteed 113,000, but they actually ran better. They didn't hit that maximum, and I'll show you in a couple of slides the monthly budget accounting forms and the amounts that you see that goes in and goes out each month. So 113 was guaranteed, but like mentioned earlier, any reserves that are set aside in that monthly budget funding of a difference card client that are left over at the end of the year go back to the group 100%. So this group actually funded in $13,000 more than what they actually used on the plan. And so that's set in reserves and it goes back to the client at the end of the year. So if you think of this approach as almost like a level funded recreation of setting aside for claims, we're not keeping any retainer of those reserves. So 100% return. And while we were guaranteeing a 21% increase, it actually equated to 17% increase versus that 42 if they would have just taken that Kaiser renewal. So effective here for Kaiser, other carriers, all markets, and we've really seen this product, like we said, explode across the country. What did it mean for the group that received these results? Well, as you know, if you've worked with us, the first step is to manipulate the plan that you use from the carrier. So step one in working with the difference card is let's identify an alternate plan design that we can use, typically from that same carrier, that same network. So you're not disrupting doctors or hospitals or pharmacy benefits or anything like that. So in this move, we looked at the client and we said, okay, you have this rich copay plan today from Kaiser that's typical for most California groups. They're buying the $20 or $30 copay plan with usually a no deductible and a really low out-of-pocket maximum. So that gives us an opportunity to move within that complete suite and go down to a really low cost plan. In this example, use a $5,500 deductible first plan, but that yields so much premium savings that it allows us to typically give a really rich benefit up front. And so this would be an example of an approach where we would give first dollar coverage. So the member in this example, yeah, they have a different Kaiser card, but they're still going to all their same providers, doctors, pharmacies, facility locations. They're presenting that Kaiser card, and then they have a difference card that's got a pretty rich benefit on it. The first $6,000 of that, $7,500 out-of-pocket maximum that they're actually enrolled in. So pretty popular approach with Kaiser groups, with some other groups in specific markets. Yields really high results, but a really easy and rich member experience. Everybody gets that card. We'll put a sticker on the card after our education through open enrollment. That's kind of their cheat sheet on the card to help them remember the benefits that they have. But it's as easy as using this like a gift card to pay for those costs that are associated with now being enrolled in that little bit different Kaiser plan that they're presenting to their doctor. So if you've seen our exhibits, you'll know how we break this all down. We show you obviously the starting point that comes from usually the carrier renewal, tells us who's enrolled, how much you're paying, and if you take that 42% increase, the total amount that would be required to fund that plan as is. This group, we mapped them to that lower cost plan, showed them a lower fixed cost amount, and then difference between revised fixed cost and revised max cost would be the allocation of those claims fueling our card swipes, and done on a monthly basis. So like we reviewed earlier, this group, they've funded in a total of $649,000 throughout the year, and that guaranteed the savings that we listed here. Now, they had money left over, and that went back to them at the end of the year, but they didn't experience really any fluctuations in costs. We were able to replicate being fully insured. They paid Kaiser much less, and then they paid difference card once per month, and it accounted for our admin and for the claims amounts that sets aside in an account that they own, that they have full transparency into. And again, at the end of the year, any money left over goes back to them 100%. We do always project out 5 years. We want to show this as a long-term solution, and we have over a 90% client retention rate. So this is for many, many groups. They get accustomed to this platform and they take advantage of this reallocation of dollars in this strategy to make it a long-term solution. So we projected out, a pretty large amount over the next 5 years, and this will actually live and breathe with the client as we renew. And we do have a renewal exhibit built in here too. So this group did renew, but I first want to kind of show you what their budgeting information looks like through the monthly budget report that we provide. So you'll see that the group fluctuated a little bit based on headcount, but the amounts that they funded in is fixed. It's a fixed per employee per month based on that headcount. And so this report's available every month. Again, those dollars are going into an account that they own, but all they've done is they've funded this based on headcount once per month, and then that allows those cards to be used as needed. And they're not experiencing those daily fluctuations of the daily use of the member. And then you'll see that they ran well. They ran in surplus throughout the year, and they actually ended with those dollars left over, a little over 13,000. That's the amount that they set aside, and it's their dollars, but we didn't retain any of that. We sent that back 100%. So all three of these case studies, we kind of wanted to walk you through the progression of how we initially wrote it, how they ran, and then how they ultimately renewed. So this group, they had a favorable year. They didn't hit their maximum, equated into the next year renewal with the difference card, renewed them at 17% and actually projected out and gave them more guaranteed savings for the 2025 plan year. So if we look at the next case, it's a little more traditional build out of difference card where we maintain a copay plan, but similar results here. So another group with a 40% increase with Anthem of Ohio. We were able to reduce that by 25%. We guaranteed that it was just going to be a 15% increase. This group actually ran over their maximum. So it was good that they had this in place. They ended in deficit, but we'll kind of contrast what those reports look like and what happens with that group versus having that surplus. But the guaranteed savings that we were able to project in 2024 was just that. It was a guarantee, even though they spent or used $12,000, almost $13,000 more than what they funded in for claims. Well, that's the assurance piece and the reinsurance component of the plan that protects this group. So real success for this group. We avoided the 40% increase, capped them at 15%. And again, they renewed into 2025. But when we look at the plan design for this group, this was a manufacturer. They were used to having a copay plan in place, and they wanted to maintain that look and feel, which if you've worked with us in the past, we can do really anything that we very flexible as far as aligning this card with a base plan from the carrier. So they wanted to keep a copay plan, but they wanted to reduce premium. So instead of buying that $2,000, $2,500 deductible copay plan, we moved them to a $6,000 deductible copay plan. So copays change a little bit. The deductibles, the out-of-pockets went up, the ER went up. But what we did is we aligned this card to make up those differences. So difference card, we can make up any difference. We can give first dollar coverage. We can pay on the back end of a deductible. You can really use this to kind of go in and dissect that plan, and then ultimately give the plan design to the employee as what you want to ultimately deliver. And then it's again going to be information on the sticker. It's going to help remind the employee when they go to their provider where they can use it and for how much. But the presentation of that plan there in the middle is then bought down by the use of the difference card at doctor and ER. And then of course we're reimbursing on the deductible and any of those out-of-pocket changes so that the member really feels no change, and that they now have a free primary care copay. So you can do little things like that with difference card as well, customize that plan, and also enhance the benefits that the members experience. So we just look again at the breakdown here, a 40% increase, making no change to the Anthem plan. The buy down gets us down to just 3% over current. And then the funding of claims, difference between the 727 And the 811 is the amount that they put in for those claims every month. And that guaranteed the savings. It projected out 5 years that they were going to have long-term strategy with the difference card, lowering that premium paid to the carrier, and then the compounding effect of that each year equates into that 5-year savings that I think we have built in here as well. So this group funded in again incrementally, just like all of our groups do on the monthly budget feature, but they actually started using the plan more than what was being funded into it. So if you look on that far right-hand column where we see either a surplus or deficit, you'll see they ran in surplus for a couple months, and then they went back and forth for a couple of months, and then they actually went into deficit, meaning they're using the card more than they're funding in. But that happens for some of our clients. That's why they like this protection. And that's the effect of the partnership that we have with Assurant. So those deficit months, nothing happened any different from the following month for that client. They based their funding of claims off of our underwritten per employee per month maximum. And so they felt none of those fluctuations throughout the year. They paid their carrier premium, they paid their difference card claims amount, and that's all that they did. Now, at the end of the year, yeah, they did end in deficit, but that was the accommodation and the coverage that they received from having that difference guarantee, again, backed by Assurant in place. So even though they ran in deficit, they did renew. We, again, prove ourselves year over year. We go back to the carrier. We show that you continue to buy the lowest cost plan from the carrier, and we will build you back up in comparison to that higher cost plan that you were with, with your carrier previously. So, yeah, they ran in deficit. We were still able to align ourselves and renew this case and still provide really rich results for this group, which is typical. We have a really high retention rate overall in our block of business, and particularly for the monthly budget clients that we've brought on here over the last year and a half. So I think we've got another poll question, and then I know Ashley has another East Coast exhibit to review.
Yeah, good stuff, Josh. Just curious, as Josh was going through these case studies, I'm wondering how many people on the call have used this with any of their clients. Have you placed the difference guarantee monthly budget with a group? We'll give everyone just a couple more seconds to submit. All right, let's share these results. So I'm actually a little surprised that 25% of attendees on the webinar today have used the monthly budget. We've got 75% on the call who've not tested it out yet. So let's pass it over to Ashley, and she's going to walk you through a New York case study.
All right, great. Thanks, Taylor. So moving over to the East Coast, this was a great case. A broker came to us and said, hey, we're trying to win the BOR. We have a nonprofit. They were expecting around a 10% renewal increase, and they're looking at over a 15%. How can you help? So just looking at the demographics of the group, they had about 124 enrolled in the medical plan. Once again, they were expecting that 15% increase from the carrier. We worked with the broker to price out a $6,000 high deductible plan and then added in the difference card MERP to get their costs to a negative 8%. So we certainly solved the problem that they were looking to accomplish in decreasing their renewal. So in terms of savings, there's about a 23% spread there, and guaranteed worst case is about $560,000. So a really great solution for a nonprofit that was struggling to control costs. And then they were also looking to improve benefits, which we'll get into in a further slide. With this group, they actually ran a deficit for the first year with us. So it was a 4-1 renewal. We just wrapped up their renewal, and they were about an $8,000 in deficit. So at the renewal meeting, they were very happy that they had the difference guarantee product in place and they had that protection there. So that was always a great message to deliver to the employer. And then looking forward, the 2025, 2026 renewal, we got them more within the budget that they wanted to be at a 10% renewal increase. And we are also enhancing benefits for a second year for them. So really exciting news to deliver to the employer. When we look at the benefits that they had and what we moved them to, Left-hand side, really great copay plan that they had, $30 primary care and specialist, $1,000 deductible, $3,000 out-of-pocket maximum, but they were paying a lot of money in insurance premium to deliver that plan to their employees. So we worked with the broker, we priced out this base plan in the middle, went with a $6,000 deductible plan with Aetna, same doctor, same network, so no disruption there. And this helped reduce their health insurance bill on a monthly basis. And then here's where the MERP came in. We designed this plan over to the right where we're going to show first dollar coverage. So the difference card would cover the first $5,000 worth of medical expenses. So for an employee who's on this plan and they don't have any claims above and beyond that $5,000, they actually pay no out-of-pocket cost for copays, hospitalizations. So this is a great plan to deliver to employees. And even if they exceed that $5,000, their worst case scenario is the out-of-pocket maximum of $1,000, which is better than the benefit that they're on today with a $3,000 out-of-pocket maximum. So this is very well received at the open enrollment meetings. Employees are really thankful. Obviously, they're not highly compensated from working at a nonprofit, but they have great health benefits now. And look at the financials. Once again, this goes back to 4/1/2024 when we wrote this case. They were paying the carrier about 2.4 in insurance premium. If they renewed as is, their costs were going up 15% to 2.8. The revised fixed cost is for that $6,000 deductible plan from Aetna plus the difference card service premium. So that brought their fixed cost down to 1.9. And then what we told them, revised max cost, the worst case scenario here, we're reducing their renewal to almost a negative 8% and guaranteeing $560,000 in savings. And then just as Josh mentioned with his two case studies too, our solution really takes into play the effects of compounding year over year. So assuming a trend 9% renewal increase, if they stayed on their current path versus move to the MERP solution, we're expecting to save this nonprofit about $3.3 million in total healthcare costs over 5 years while still improving benefits. And what I really like about the MERP solution is the transparency with reporting. So this employer was able to track exactly how the plan was running from month to month. And this is something that our retention team is very involved with, helping plan for future year renewals as well. So if you look over to the right on the column that says surplus or deficit, you can track how they ran over this past year. And they were on a slight roller coaster ride. They started out in the black, they went in the red, they were back in the black. And then ultimately they ended the year with about an $8,000 deficit. So that's where they were really happy that they chose the right product. They had the monthly budget in place. They didn't deal with budget fluctuations throughout the year, and they didn't exceed that maximum cost that we had given them during the new business sales process. And then looking at their renewal, once again, it was really important, and what they communicated to us was to have around a 10% renewal increase year over year at max. That was something that they were really budgeting for, and just based on their current financial situation was really important to them. So the conventional costs, we had worked with the broker to price out the old $1,000 deductible plan that they're at. In 2025, that was going to cost them over $3 million. The revised fixed costs for the $6,000 deductible plan plus the difference card service premium brought them and gave them almost $1 million in savings here. Then adding in that worst case scenario with claims of almost $300,000, we brought them down to a 9% renewal increase. And the savings actually went up from the prior year, $560 up to $645. So this was an easier renewal for our team, all great messages to deliver to the employer. So they were very happy. All right, Taylor, poll question 3. Do you want to take us through that?
Yeah, so we've heard Josh and Ashley talk about a technology company, a manufacturing company, and a nonprofit. But when you think about industries that in your market would really benefit from having this monthly budget structure, what comes to mind? Is it technology? Is it manufacturing? Maybe it's nonprofit, like we just went through just now, healthcare, or construction. Where do you see this being a good fit in your particular market? We'll give everyone just a couple more seconds here, and then we'll share our results. right, let's see where we ended up here. So, no surprise, Ashley. I think that last case study really resonated with them, with nonprofit being the top result here for where this would really make a big impact, but also manufacturing and technology coming not far behind. Healthcare and construction, we got a couple of votes there, but really interesting to see how this all played out. But this is where we see it working very well, so no true surprises.
Perfect. And then just to wrap up, I mean, we talked a lot about the monthly budget solution today and how the medical expense reimbursement plan can help control costs. So ideally, we're a fit for groups 25 enrolled, upwards of 1,000, if they're on a fully insured plan today or level funded. If they also have a high level of benefit, so if they're enrolled in that example I gave with a gold plan or a platinum plan, they're paying a lot of money in insurance premium to the carrier, so we can help them create a more cost-effective healthcare plan by reducing the fixed premium to the carrier and then layering it on the MERP. So savings has certainly been one of our biggest leaders. We're dealing with the groups with a lot of difficult medical renewals that are coming to us saying, hey, how can you help solve this problem? And then, as I mentioned in my case study too, we have a lot of clients that are interested in improving benefits and giving that first dollar coverage, giving $0 office visit copays, just as incentives for members to go in and receive that care that they need before it turns into something serious. So especially in that small group market too, where there's a lot of canned plans, we can actually create plans in the MERP that don't even exist from the carrier. So that's one thing I think I like most about the MERP is the flexibility and then the creativity with the plan designs that we're creating for our clients. And then with the monthly budget side, we talked a little bit about industry, so nonprofits, municipalities. Those are really our biggest clients that can't deal with the fluctuation from month to month with the claims aspect. And that's really why we created this product. So just thinking about, hey, I'm going to set it and forget it. I'm going to pre-fund the claims. I'm protected with that difference guarantee if I go over the claims amount that I gave the difference card. So it's much easier from an accounting standpoint for an employer to figure out exactly how much the MERP is going to cost. And then you have the upside potential too. If it runs well, you get 100% of the surplus back. So we're coming up and really on 7/1 renewals, we're getting closer. If you have a group that's still outstanding and you need us to help reduce their medical costs, we can certainly do so. So how to request a quote, really the data that we need are medical rates and enrollment by tier. If you have a plan design, that would be helpful too, just so we can look at what benefits that they have in place today. We can also build in broker compensation. So we traditionally do $5 and up in increments of 5. So that can be a conversation that we have, and this can be on a case-by-case basis. So to get the ball rolling, we have the sales email here. That goes into a general email box, and then we can connect you with the right senior consultant on our team.
Great. Thanks so much, Ashley and Josh. I can tell that you really got everyone's wheels turning because there's been a lot of chatter in the chat, a lot of questions. So we're going to open it up for any additional questions. I know Chris has been really busy trying to respond to everybody, but we're happy to take a little bit of our remaining time today to answer questions you might have. So Chris, I'll turn it over to you.
Yeah, maybe I'll just do a quick review for those that have not kept up with the chat in general, just kind of like scan through some of the questions that we got to, and maybe there are some others we haven't gotten to yet. Todd just asked the question about the revised fixed cost. We provide all of these illustrations to you as the broker and the consultant, and it's up to you to decide what you want to show the customer. Some of our brokers will show them, here's the revised fixed cost, and then here's what we're building back on top of. Others will make it simpler and just show here's kind of the net effect. So we'll work with you to come up with the right strategy to present this to your customer. Margaret asked a question about the municipal market. This really works very well for that public sector market. They were demanding of us to say, hey, I can't go over whatever I budget for, that's it. So this program is perfect for that nonprofit and public sector municipal market. That's a great point. There were some questions about renewal increases. I think first dollar versus last dollar, what we typically see is it's about how is that kind of high claimant risk of that specific group that has a bigger impact than kind of the first dollar coverage from what we've seen, at least on our book of business. Minimum size. We talk about 25 lives is the minimum for the monthly budget solution. Difference Card does have other programs that will write down to 10 lives, so we will work in the smaller group space. But for this product that we're talking about today, it's a 25 enrolled minimum. There's a question, this is a new one about loading. So from Lori here, for large group, if you put in Difference Card, Kaiser will load rates. So when we showed these case studies, there were some loads built in, but it still works even after those loads have been accounted for. And each carrier is a little different. So Kaiser may have a load, whereas Aetna doesn't. Depends on the market and the specific case that we're talking about. But we'll absolutely factor that in with you into the exhibit when we're presenting. Aaron's asking a question about reporting. We do monthly paid claim reports with utilization detail on a month-to-month basis. You get access to a secure portal as the consultant, so you'll be able to log in securely, pull down any reports you may need for your customer. We can also set the customer up with reporting as well, so they can log into that same portal and see the claims. There's a shout out here to Jen Revelle. Jen doing a great job in the Indiana market. All right, Tom had a question. This is actually on the Q&A side, not in the chat, about HSA plans and what if they already have a 5,000 or a 6,000 plan. So eventually you do get to the point where there's nowhere else to go. If you've already quoted an $8,000 deductible, well, every year the out-of-pockets and deductibles tend to go up a little bit, but we're kind of getting to the end of the line there. Some of those groups may want to improve benefits. So we've done that where we can improve it to a lower deductible at a more efficient price point. But there is still some room. Like we've got plenty of HSA groups that maybe have a $3,000 or a $4,000 deductible today. We'll buy that $8,000 and we'll back end fund the last, let's say $4,000. So HSA first, which Difference Card also administers the HSA if you want us to. Then we'll MERP the back half of it, keep it qualified, and save them money on the fixed costs. Mark's got an interesting question. I thought we'd get a GLP-1 question here about maybe a weight loss drug that's not covered. So we can cover it if it's something that is considered a medical expense in terms of the 213D eligible expenses. So we have to stick by the IRS codes of what is eligible. And some of those things that may not be covered by the carrier can be covered by us if we want them to, if the employer wants them to. That's part of the customization that they get from the Difference Card. And then it's a matter of whether we're going to put that in the guarantee or not. Most of the time, things like that get carved out of the difference guarantee because the difference guarantee will follow the carrier plan. And then we'll have kind of separate buckets for different things like we do dental reimbursements, vision reimbursements. I've seen the weight loss bucket as well as a new recent one. All right, Chris is asking a question about comparing to self-funding. What amount of data will we get? So it's not going to be as detailed as self-funding because you're not going to get the full plan. Once they hit the out-of-pocket max, right, we don't get the data anymore. But before they get to the out-of-pocket max, we do get a lot of detailed paid claim information in that part of the plan. So the front end part that before they hit their deductible or out-of-pocket, we are getting a lot of detailed data that we can share with you all through that reporting portal. So we showed you some of those summary charts today, but there's a lot more detail that we can give to you in detailed spreadsheets from the database behind those reports. All right, good stuff there. Maybe last question that I'll just address was from Jeff about can we help navigate to lower cost facilities and drugs. So this is kind of alluding to something we'll probably talk about more in a third quarter webinar. We call it Plum. It's Provider Lookup Manager, where we do have the ability to steer members to high quality, cost effective providers, kind of a top docs type system. And you can have the reimbursements if they go to those top doctors, and maybe if you choose to not reimburse them if they choose not to use one of those Plum providers. That's something we're certainly going to talk more about as we launch that a little bit broader in the third quarter of this year. And then I know Mark asked a question about HRAs here. We do HRAs as well, health reimbursement arrangements. They're more kind of simple cookie cutter plans. We do that very well as well. So something to talk to your sales rep about.
Chris, there's one I do want to bubble up to the top because I think it's a good one for everyone on the call to hear. We've got someone asking, does this work in all states? And could a Difference Card rep be involved in a meeting with a potential client?
Yeah, so Difference Card does work in all states. There's no state restriction. We've got customers in all 50 states, and we've got salespeople on the ground in I think 23 states and growing right now. So we're trying to cover the whole country there. And we absolutely want to be there with you to help you present this to your customer, make you look like the expert that you are. So if there's a question that is super detailed, we'll be there to help answer it. So absolutely work with your senior consultant. If you're interested in learning kind of who is your senior consultant, right on our webpage, there's a locations map, and you can kind of click on the state that you're in, and you'll get the contact information, the email, and the phone number of that senior consultant who's assigned to your part of the country.